Hey guys, it's Jenny Silver, and today I want to talk to those of you who are gig workers. If you drive for Uber, Lyft, DoorDash, if you work and earn money or plan to do so in the gig economy, there's a lot of very important information that you need to hear that most aren't going to tell you. This is extremely important. So if you plan on participating in the gig economy and earning money that way, I want you to watch this video from start to finish because there's a lot of information in here that is really important to know that isn't shared everywhere. The first thing that I want you to understand is that you're going to be a self-employed individual. Well, you might already know that, but the important thing here is that you are going to be required to file self-employment income taxes. Regardless of if your platform sends you a 1099 form, you are required to file self-employed income taxes if you earn over $400. Anything below $400 is technically a hobby in the eyes of the IRS, but if it reaches $400 and goes beyond, you are required to claim it on your income taxes. Now, many low-income individuals may think that they do not have to file income taxes because they fall below the IRS's minimum threshold for requiring a tax return. Well, that does not apply to self-employed income. With self-employment income, the IRS states that you must file a tax return if you earn over $400 in a year. The next thing that you need to know is that this applies regardless of whether or not your platform sends you a 1099. Now, for companies such as Uber and Lyft, they're going to be sending you out a 1099-K, but they don't send out a 1099-K to everyone. In order to receive this tax form, your gross payments must have exceeded $20,000 from the company, and you must have had more than 200 such transactions. Now, that is a large number. So there's a big gap here between your filing requirement threshold, which is $400, and that $20,000 mark, which is going to mean that they send you a tax form in the form of a 1099-K. Now, that is a large number. So there's a big gap here between your filing requirement threshold, which is $400, and that $20,000 mark, which is going to mean that they send you a tax form in the form of a 1099-K. The next thing I want you to know goes against what many of the popular YouTube channels will tell you. Many popular channels will tell you to write off all of the possible deductions that you can on your tax return to lessen your tax bill. Well, unfortunately, this is going to have some negative consequences as a result. So you're going to need to weigh, based on your own unique situation, if it makes sense for you to actually claim all of those deductions. Now, the first thing I want you to know about writing off all of your income through tax deductions is that you're going to have a very low net income, and in some cases, $0 net income or even negative. This can have an adverse effect on you if you are trying to apply for different things, such as loans, financing, apartments, mortgages, etc. Now, writing off all these tax deductions not only has an immediate consequence on lowering your net income, but it also can affect you for 3 years. If you are someone who is going to apply for purchasing a home later on down the line, mortgage companies and financing applications are going to look at 3-year averages of your self-employment income. So this is something that you definitely want to keep in mind when it comes to tax write-offs if you're someone that has plans or hopes to buy a home later on down the line. After taxes, the next thing that I want you to take into consideration is how your finances are set up. As a self-employed individual, you're going to have a careful way to account for all of your business deductions, expenses, and income. Now, I recommend opening up 2 completely separate accounts from your regular personal accounts. These can also be personal checking and savings accounts. They don't have to be business accounts because most likely as a gig worker, you do not hold a business license. But open up 2 additional personal accounts. One is going to be checking and one is going to be savings. The savings account is going to be for setting aside your estimated amount that you're going to owe for income taxes, self-employment taxes at the end of the year. We'll talk about that more in detail later on. The other account is going to be a checking account, and this is where you will receive your payments from your gig work as well as pay for any business-related expenses. Only use those two accounts for your work and don't combine them with personal bank accounts. This way, at the end of the year, your finances are completely separate. All of your income and deductions are all very easily accessible through these bank accounts. Next, let's talk about taxes. This is extremely important and probably the section of this video that you want to skip over the most. But it's so important, you guys, so please watch this whole thing so that you don't get yourself into a bad situation. Now, as a self-employed individual, you're going to be subject to paying self-employment tax come tax time in April. Self-employment tax is 15.3%, which equals Social Security and Medicare tax. In addition to that 15.3%, you are also going to be required to pay regular federal taxes and state taxes. As a generalization, it's usually a good idea to estimate at least 30% of all of your income to be set aside for taxes. Many people wonder if they should estimate this based on their net income or their gross income. Gross income is the total amount of income that you receive, and net income is how much you actually keep once you account for your deductions. You are going to be taxed on your net income. However, as a safety net, I strongly recommend setting aside 30% from your gross earnings because it is the absolute worst to be unprepared for income taxes. Self-employed income taxes can be quite a shock, especially if it is your first year being self-employed. Which brings me to my next point, that when income taxes are due, if you owed over $1,000 in federal income taxes, you are not only going to be required to pay that year's owed balance in taxes, but you are also going to then be required to pay first quarter estimated taxes along with that tax filing. This is an additional expense that many people don't realize is coming and can be hard to plan for. Now, if you earn over $1,000 in that tax year, the IRS then wants you to pay out an estimated amount of what it thinks you will owe next year. This is done on a quarterly basis. So that means that the IRS takes what they think you will owe, breaks it down into 4 separate quarters, and has you pay off one of those payments every quarter. The first of these payments is due right along when you file your income taxes. This can be a big blow if you are not expecting that additional amount due in taxes. Which brings me to my next point, which is what happens if it is tax time, if you have a larger than anticipated tax bill and you do not have the money to pay it. The IRS does allow you to request a payment plan wherein you can ask the IRS to take what you owe and break it out into a series of payments throughout a certain time span. Now, this has a few benefits. Not only does it give you additional time, but if you request a payment plan as opposed to simply not paying your balance and waiting to pay it off, the IRS reduces the amount of penalties that it assesses to that late tax payment. So for those of you who work or plan to work in the gig economy, let me know in the comments down below. Did you already know all of this information or is it new? Okay, you guys, I hope that was helpful. And please click like, subscribe, and leave me a comment down below. I'm going to be working in the gig economy. If you're going to be a drive share rider, a drive share rider, that's the opposite. Too much stuff on my desk. Dropping everything. Down below, did you already know all of this information? Those of you who work in the gig economy, I don't know what this is.